Alright traders, let's have a serious moment. The majority of traders don't succeed because they're locked in on all the wrong aspects. It's the reason nearly 90% never see consistent results. Sound familiar? Maybe you've been spending countless hours plotting out order blocks, thinking that's the ultimate key. But here's the truth. Just identifying them won't cut it. What really matters is whether you know how to apply them like professional traders do. That's why today I'm going to break it all down and share 3 powerful order block strategies that might completely shift how you approach the markets. Here's what you'll gain to sharpen your trading. Precision entries. Discover how to pinpoint high probability setups by recognizing essential order blocks across various time frames. Inducement traps. Learn to capitalize on concealed liquidity sitting near major order blocks to catch explosive price moves. Breaker blocks. Reuse previous order blocks as fresh resistance zones to identify excellent shorting conditions. But before we dive in, don't forget to hit the like button to support the content and subscribe to the channel if you're joining us for the first time. I'll see you right after the intro and disclaimer. The real question is, how do you actually apply these strategies in real-time trading to achieve the best outcomes? Most traders miss the crucial details, but if you stick around, I'll show you exactly how to put them into action. This might just be the breakthrough your trading needs. Let's get started with the first strategy. We'll begin with one of the most effective entry methods, order blocks. First, examine the higher time frame to identify significant order block zones. Then, switch to the lower time frame, wait for a clear change of character, and fine-tune your entry for pinpoint accuracy. Let's walk through it step by step. Alright, let's bring up the 4-hour chart. This is our higher time frame. The first thing to do is evaluate the market structure. Right now, we're looking at an uptrend, and this move here has created a strong bullish order block. This zone is essential. It's where big players typically place their trades. Now here's where discipline matters. We don't enter just because we spot an order block. We wait. If the price retraces to that level, that's our cue to pay attention. If not, we let it go. No chasing setups, no forcing entries. Now let's zoom into the 15-minute chart. Here's what you'll observe. We're currently in a downtrend. And before even considering an entry, we need solid confirmation that buyers are stepping in. That confirmation comes through a change of character, specifically a break above the current structure. Watch carefully. Right here, we get a clear break and close above the previous high. That's our cue. Next, we identify the latest bullish order block in this move. That's where we fine-tune our entry. Now that we've found our zone, let's talk about executing the trade. We place our buy order slightly above the order block, and our stop loss just a few pips beneath the lowest point of the zone. This keeps our risk in check and avoids unnecessary losses if the setup doesn't hold. For take profit, we've got a few strategies. First, we aim for a 1-to-2 risk to reward ratio to lock in partial profits. After that, we can target the next structure level or trail our stop loss, securing more profit as price pushes higher. Now here's where it gets exciting. As price climbs, new order blocks will develop. Each time a fresh bullish order block forms within the ongoing trend, it creates a new chance to enter. Look right here, we see a clean new block giving us another entry. And over here, yet another one appears, providing an additional opportunity to scale in. This is how experienced traders compound positions, amplifying returns while still managing risk. This isn't some gimmick, it's a structured method for following market behavior. Next time you're analyzing charts, pay close attention to structure, order blocks, and confirmation signals. That's how you trade alongside the smart money. And up next, the following strategy takes your entry accuracy to the next level. Stay tuned. Now let's dive into the second strategy. Ever placed a trade and got stopped out just before the market reversed? Annoying, isn't it? But what if I told you it's not just bad luck? These stop-outs are actually part of a pattern known as inducement traps, and once you learn to recognize them, you can start trading like institutional players. An inducement trap occurs when a minor key level appears close to a major order block. Imagine this: price is moving in an upward trend, leaving behind a strong demand zone. This is where the institutional players are positioned to buy. But instead of price immediately returning to that zone, it forms a temporary support level just above, with multiple rejections. Looks convincing, right? But here's the catch. This is the trap. Retail traders spot that level, believe it's a strong support, and start buying in heavily. What they don't see is that smart money needs liquidity to enter at more favorable prices. So, what happens next? Price sweeps the inducement level, hitting stop losses, and then taps cleanly into the major order block before making the actual reversal. Retail traders, they're taken out. Institutional traders, they're in, at a premium zone. So how do we trade this like the pros? It's straightforward. Instead of buying at the inducement level like most retail traders, we wait for price to drop into the actual order block. We set a buy limit within the major order block, making sure we only enter if price reaches the genuine demand zone. And here's the best part. If price never touches that level, we stay out. No forced trades, no unnecessary risk, no chasing. Now, you might be wondering, does this setup really happen that often? Absolutely. It's a recurring pattern, because this is exactly how institutional traders operate. They don't enter randomly, they engineer liquidity traps to fill their positions. Now let's take this concept and apply it to a live chart example. Take a look at this chart. Price surges upward, leaving behind clear inefficiencies. Then we get a confirmed break of structure, boss, validating a proper order block. But here's where things get interesting. Right before price reaches that order block, it begins forming multiple rejections at a minor support level. That's our inducement, and now we know exactly what's coming next. So what's the strategy? Simple, we set a buy limit within the major order block and wait. No guessing, no chasing price, just patience and precision. And right on cue, price sweeps the inducement, triggers stop losses, taps directly into our order block, and reverses cleanly in our direction. Retail traders are taken out, while we enter with a near-perfect setup, clean, accurate, and high probability. When it comes to execution, we stay sharp, stop loss goes just below the order block to limit risk. For profit taking, we aim for a 2 to 3x risk to reward ratio. Some traders even treat the inducement area as a partial take-profit target, securing gains while allowing the rest of the trade to run. And just like that, the trade unfolds exactly as anticipated, turning what seemed like a retail trap into a high-quality opportunity for us. Now, let's move into the third strategy. Here's the concept: when price makes a strong move upward, it often leaves behind a key zone, the last solid green candle before the breakout. This zone is known as an order block. Typically, when price returns to this area, it acts as a support level. But sometimes, price doesn't respect that zone, it drops below it, breaking previous lows. That shift indicates something crucial, a change of character. It signals that momentum may be transitioning from bullish to bearish. So, what happens next? Price begins to climb again, but this time, instead of the old order block holding as support, it turns into resistance. This is what we refer to as a breaker block. It's like the market is saying, what was once a buy zone has now flipped into a sell zone. Traders who miss this shift often assume the market is still heading higher, only to get trapped when price reverses from the breaker block. Now let's take a look at how this plays out on a real chart. Notice this strong upward movement. See how price forms a new higher high. That's where we identify the last solid green candle before the move. That's our order block. But here's the twist. Instead of holding above that zone, price drops sharply, even breaking below previous lows. That right there is the change of character, a sign that the bullish momentum is fading. Now visualize this. Price begins climbing again, but instead of continuing higher, it rejects the same level, the breaker block. That's your confirmation the market isn't pushing upward anymore, it's reversing. This is where we look for a short entry. Set your stop loss just above the breaker block, and you'll take profit at roughly twice the size of your stop, giving you a solid risk to reward ratio. Imagine this trade playing out. Price drops as expected, your target gets hit, and you lock in a clean profit. That's how smart money operates. Now, since you've made it this far into the video, I want to share a bonus tip, something I usually keep private, but you've earned it. Here's a scenario I see all the time. Price aggressively taps into an order block, and most traders freeze. They don't know whether to jump in or stay out, and often miss the move or enter too early. What I do is simple. When price returns to the order block, I wait. I don't rush. I observe carefully for a confirmation signal. The key thing I'm watching for is a change of character. That might look like a bearish engulfing candle, a strong wick rejection, or even a quick liquidity sweep followed by a clear directional shift. As soon as I see one solid confirmation, that's my entry signal. I set my stop loss just below the order block and target the next structure high. That's it. The secret is letting the market reveal its intent before you jump in. That's how professional traders operate. No need to overcomplicate things, just mark your zone, wait for confirmation, and execute with confidence. Simple as that. That's all for today, traders. Thanks for watching the video. I hope you found this content insightful and valuable. If you did, make sure to like and subscribe the channel, and enable notifications so you never miss our latest uploads. We genuinely welcome your thoughts and ideas, so feel free to share your comments below, and let us know which topics you'd like us to explore in upcoming videos. Thank you for your continued support, and we look forward to having you with us in the next episode.